Should you modify your portfolio allocations right before a presidential election? You know, like the one we're going to have just 3 days from now. Over the past 9 presidential elections, going all the way back to 1988, how many times did the equity and bond markets move higher in the 2 months after the election versus how many times did they move lower over that same 2-month period? As you can see from this graph, the equity markets were down only twice over these 9 election cycles, and this is starting on November 1st and ending at the end of December. So you can see that 7 out of the 9 times, the markets either finished slightly flat like these two or up substantially like these. And by the way, this is up about 13%. You know, this is up 10%, 5%, 0%, down 5%, down 10%, to give you some perspective. And if we look at the statistics for these returns, the average return 2 months after the election was up 2.61%, median return up 2.58%, and maximum return, as I pointed out, just a little over 13%, and the maximum loss 2 months later, just about 7%. And you can see that 78% of the time, the markets finished higher 2 months after the elections at the beginning of November, and just 22% of the time, the markets finished lower after the elections. One thing I can tell you for sure is the equity markets don't like uncertainty. And has that ever happened recently after a presidential election? Well, yes, it has. If we go back to the election in 2000 between George Bush and Al Gore, if you're old enough to remember, George Bush contested the results of that election, and that threw the markets into some major uncertainty. Now, how bad was it? Well, if we look at the 2000 election, that is this green line, this light green line here, and you can see that, yeah, the markets fell right after the election and continued moving lower all the way through the end of December. Now, they ended up down, looks like maybe 6-7%, so not terrible. This was the worst drawdown of all of these over that time period. But, 6 or 7%, that's a normal correction. So it's not like they tanked, 15, 20% or something totally crazy. Now, could that happen in this current election? Yeah, it could. We're all aware of the potential risks in this election for it to be contested. But that doesn't mean I'm suggesting you should make any changes to your portfolio. Now, what about bonds, treasuries? What happens to treasuries and what happens to the yield on treasuries after elections? Well, here's that same exact graph, except here, instead of looking at the growth of the S&P 500 or the growth of bonds, I've looked at the change in the yields on the bonds from the beginning of November until the end of December. So you can see in the worst case here, the yield on the 10-year treasury went up about 0.6%, something like that. So not much, right? Now, we're currently at about 4.38% or something, called 4.4. So if it were going to go up 0.6%, that would put us up at 5%. Highly unlikely that's going to happen. It could, but I don't think it's going to. And then on the other end of the spectrum, you can see that yields dropped a lot here. They dropped over 1.5% during this election, during the 2008 election. Now that would make, by the way, when yields go up like they did here, that makes the price of the bonds go down. When yields drop like they did here, that makes the price of the bonds go up. So if they drop like this, bonds are going to go through the roof. If they go up like this, bonds are going to fall. But you can see there's no predictable behavior here. It's all over the map. In fact, if we look at the statistics, you can see that 67% of the time the yields went up, meaning bonds fell, and 33% of the time the yields fell, meaning the bonds went up. And you can see those 3 instances here below this no change line. And the changes weren't that big. I mean, the average yield change was minus 0.09%. That's almost zero. The median yield change was 0.04%. That's almost zero. The worst case yield change was up 0.66%. And the worst case drop in yields was minus 1.66%, which is a real big outlier. Now, just to give you some sense of what that means when yields drop or they go up, what I've done here is I've plotted the price of TLT. TLT is an ETF that invests in 20-year Treasury Bonds. And I've plotted the price of that versus the yield on the 10-year Treasury notes. And you can see that these are kind of all over the place. And why are they all over the place? Well, if you look at these data points here, these are in the early 2000s. And these prices, by the way, include dividends being reinvested. So let's take the dividends out. So if we can really get a better understanding of the relationship between the price of these 20-year bonds and the yield on the 10-year Treasury note. So here I've taken the dividends out of the prices. And you can see you get a much more well-behaved price behavior here as a function of yield on the 10-year Treasury. So where are we right now? Well, we're right here with TLT at $90.84. The yield on the 10-year note is 4.386%, as I mentioned earlier. And if the yield on the 10-year were to go up closer to 5%, well, TLT might drop to $85.59, something like that. That's not terrible. So what does this tell you? Well, in this current situation, we're here, and we have limited downside, very limited downside, down to here, if things go bad and yields go up quite a bit. But look at the upside potential when rates eventually come down. So my take on this is a good time to be in long bonds. Yeah, the yields could continue going up. These prices could continue to drop, but they have a much more upside than they have downside. This is the kind of situation you want to find yourself in as an investor. Look, it's clear from the data I just presented that you need to resist the fear-driven urge to do something with your portfolio allocations. Spoiler alert, this usually means selling some of your risk holdings to raise cash. The fear of the unknown presidential election results in most cases is much worse than the reality 2 months after they occur. So should you make changes to your portfolio right before a presidential election? In general, I'd say no. What do you think? Did you sell holdings or buy holdings this past week in anticipation of the 2024 presidential election coming up in just 3 days? Please let me know in the comments below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Well, if we look back over the past week, you can see what the markets did in general. They sold equities. You can see that things were flat up until Thursday, and then Thursday and Friday, they ended up lower. And if we look back over the last month, you can see we had a very nice rally going on here, and then it just really kind of collapsed near the end. And then if we look back over the past year, we still have a very healthy appetite for risk. Yes, ARK Invest is in last place here, but you can see that when things go up, it really goes up much faster than these other equity indices. And how does this look when we take a look at the current bottom dynamics? Well, you can see that the market's sold off right here. You can see that in the price action for the S&P 500. And you can see that the bottom forming indicator really shot up here and got up probably a little above 90%. And the confidence level was also rising while that was happening. But right after this major drop, you can see that the bottom forming indicator dropped. But more importantly, the confidence level, this dashed black line, really fell off here. This tells me there's no conviction behind these moves. There's a lot of noise here. And what if we look at risk versus opportunity? Well, you can see we've got a very mixed picture here. Now, you know I don't like it when risk acceleration gets up here above 60, and in fact, it's almost touching 70. So I don't like this at all. You can see that opportunity acceleration has fallen off. That's not good. So this is not a healthy looking picture right now. Will it continue to worsen as we get past Tuesday? Don't know. Depends on how uncertain the results are for the presidential election. But even with that, I recommend you don't make any changes to your portfolio. we'll get through this and the stock market will recover and everything will be fine. Or maybe it won't even pull back at all. There's no way to tell, which is why you shouldn't try and get cute with your portfolio. And what about equity versus safety? Well, this is interesting. This tells a very interesting picture. Let's jump right into the overlays. Why is this an interesting picture? Well, first of all, cash is in second place. I don't like that. You know I don't like that. Gold is still up here in first place. But what's interesting about this isn't that cash is up here in second place. What's interesting is that the NASDAQ 100, the large cap tech stocks, stayed flat in third place, while the safer Dow and S&P 500 stocks really fell back in the rankings here. So to me, this says that the portfolio changes that were made were to sell the safer stocks and not sell the big cap tech stocks. This is really positive because what does that mean? Well, if people sold the safer stocks and put the money in cash, what do you think they're going to do with it after we get past the election and the uncertainty? My belief is they're going to put it here in the higher risk NASDAQ 100 stocks. And what if we look at the safe haven assets? Well, you can see, again, gold is up here in first place. Cash launched up into second. Short duration treasuries moved higher. And then intermediate treasuries moved higher. 20-year bonds moved higher. Now, did these move higher? No, actually, bonds have been getting trashed. But the Dow Jones Industrial got trashed more. So it fell down and pushed these up. And then EDV is stuck in dead last. How does this show up in the buying and selling pressure? Now, what I'm showing you is my graphs from last week. And you can see that the price action of the Dow was moving higher. And the buying pressure was falling. And the selling pressure was increasing. And that was happening pretty much across the board. And if you look at my video from last week, I said either the prices got to turn and go lower, or the buying pressures has to turn and start moving higher. Well, where are we? Well, here we are. The price moved lower in all cases, more in the Dow than in the others, as you can see here. And in fact, you see that in equity versus safety. The Dow really pulled back here pretty substantially over the last couple of weeks. And you can see that in equity versus safety, where it really fell a lot in the rankings. So where are we now? Well, if I put the overlays on now we have falling price in the Dow and we have falling selling pressure. So, what happens on Tuesday or Wednesday after the election? Totally unknown. But right now, this is telling me we have a divergence. There's falling selling pressure with falling prices. That means either the selling pressure has to increase as the price continues dropping, or the price has to start moving higher as the buying pressure increases. We'll have to wait and see what happens next week. And what about ARK Invest? Well, very similar picture. It's really going sideways to nowhere here. Really no direction at all. And not much of a tell here in the buying and selling pressure. Now let's take a look at sector rankings. I'm going to skip ahead to sector rank acceleration because these sector rankings move very, very slowly. Although I will say it's interesting that consumer discretionary moved up in the rankings while consumer staples moved down. That's very much in line with what we saw in equity versus safety. So here we are with sector rank acceleration. Let's jump right into the overlays. So what's good here? Well, not a lot. You can see that consumer discretionary moved up. That's great. Consumer staples stayed put way down here. That's actually also positive. You can see that the semiconductor ETF moved up in ranking. That's good. S&P 500 moved up in ranking. Bitcoin moved up a lot. But the Dow fell. I'm not surprised here. But that's actually a good thing because investors were dumping safer stocks and putting them into riskier stocks or cash to be invested in riskier stocks later. And you can see that emerging companies, small caps moved up just barely, one notch. And I put a green arrow on aerospace and defense because The fact that this is here dead last place tells me that the markets don't see much geopolitical risk. Now, what looks bad? Well, a fair amount, quite a bit. You've got gold right up here in first place. That's bad. That's a safe haven asset. That's a fear asset. So investors are fearful. You've got technology, XLK, moving down. You've got the NASDAQ 100 moving down. ARK Innovation moving down. Emerging markets moving down. You've got cash moving up, only one notch, not horrible, but not great either. So there's a lot to not like here. But again, a very mixed picture, leaning a little bit more now toward the negative side as we get closer to the election day. So let's talk about Treasuries. So how have they looked over the past week? Well, kind of like equities. We had a little bit of a rally attempt here, and then they just crashed on Friday. So this really doesn't look good. And over the last month, you can see we're just in a really bad place here. This is a very bad appetite for Treasury risk with the longest duration Treasuries down here on the bottom and the shortest duration ones on the top. And then if we look back over the last year, you can see we had a big rally, pull back all the way to here, another big rally, a much longer rally, a higher peak, and now we're pulled back to here. But as I showed you earlier in my presentation, I think there's not much downside left to these. And hopefully I'll be right, and hopefully these will turn around soon. And how does all of this show up in the buying and selling pressure? Well, you can see what we were looking at earlier. You can see the prices have been collapsing across the board for most of the 2 months, especially at the longer duration end, like IEF and TLT. You can see that the selling pressure has been increasing here, and at the short end, interesting. You can see that the selling pressure has been increasing here at the short end, SHY. These are short duration treasuries. But when you go out longer to IEF or TLT, the selling pressure has been dropping as the price has been dropping. Let's see. Yeah, I put overlays in here. So these overlays are from a week or two ago. Now, this looked positive, right? You've got falling prices, falling selling pressure, falling prices, falling selling pressure. This looks good. This is a divergence that basically says these bonds should turn higher soon. Now, this is a week or two ago. So where are we now? Well, we've gone even longer with falling prices and falling selling pressure, falling prices, falling selling pressure. So when this thing turns around, it's going to really move, I think, because it's had this divergence going on for about a month and a half. That's a really long time to have divergence in a situation like this. And what about the yield curve? Well, the yield curve is interesting. It's not inverted anymore. We're about 11 basis points not inverted. And you can see that the yield on the 10-year has been moving up. Now, this says currently 4.365. I thought it closed on Friday, at 4.386. As you can see here. So this has been moving up on the 10-year, and down here at the short end where the Fed controls things, those rates have actually also moved up. The red line is a month ago, and the blue line is as of Friday. So you can see that rates even at the short end have moved up. But as the Fed continues to lower rates, these are going to drop. And I also believe the rates on the 10-year will drop with them. And why do I feel confident that the Fed might lower rates? Well, let's take a look at what the markets think. The Fed's going to meet in 5 days, and the market sentiment says that they're going to drop rates by 0.25%. 95% market confidence that rates will drop by 0.25%. This is where rates are now, and this is 0.25% drop. If we go out to December, just 1 month later, you can see there's a much bigger confidence level here that rates will be lower by 0.5%. And this is where they are right now. Now, if we go out to January, there's almost no likelihood rates will be where they are right now. And there's more of a likelihood that rates will be down by 0.5%. But there's also a growing likelihood that rates will be down by 0.75%. If those rate decreases come into play, the yields and the short end are certainly going to drop, and they should also drop at the 10-year duration. So what about gold? Well, gold, as you can see, is just kind of noodling along, moving higher. There's a reason why gold is ranked number one in equity versus safety and in sector rank acceleration. It's been moving fairly steadily higher with a little bit of wobble here, but generally up over the past 2 months. Now we have somewhat of a divergence here. Look at this big peak in the buying pressure. Normally after a big peak like this, the price will fall off, and it didn't. It went sideways and then continued higher. But as it did that, the buying pressure has fallen. So could this be the end of the gold run once we get past the election? Because if this continues, you're going to see gold start to fall, which it has already started to do the last couple of days. What about Bitcoin? Well, a couple of weeks ago, several weeks ago actually, you can see I had a lot of divergences here, but I called out this divergence with a falling price and increasing buying pressure. Now this is over a very short duration, just a couple of days, maybe 3 at the most. So it's a very short time frame to look at. But I said if this continues, this is going to go higher. So where are we? Well, this is where I was talking about back there, where you had the falling price and rising buying pressure. And you can see how the price has moved substantially higher since back here. As you can see from the price movements and metrics for equities and treasuries, the equity markets and treasuries are both treading water or moving lower until we're past the election coming up in just 3 more days. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.